Hello, everyone. Our next section will be on small business valuation, and essentially what we're talking about is buying a small business. Um, I think we have enough people at SDSU that are involved in the entrepreneurship program where in the past this exercise and this lecture has been very beneficial to them. But I also suggest this because I really don't know that I've met anybody at some point in their life who hasn't said they'd like to be their own boss or start their own business. And that gets into understanding, well, do you buy a new business or start a business from scratch, or would you go out and buy a business? And my recommendation usually is, if you want to get into that, to buy an existing business. And the reason you do that is because what you're paying for, or the difference between what a business is being sold for and just the assets it has, is the premium that you're paying for that business, but you're paying that for the client list, or we could say the ability to generate revenue. So that's why you often buy an existing business, is to have that ability, and you're not starting from scratch and having to go out and pound pavement and sell. So that's often one of the big benefits to buying an existing business. So a couple other points here I'd like to talk about is, one of the things you ask yourself is, why has our government spent billions to start entrepreneurship programs and innovation programs at universities and schools? 20 years ago, if you went to almost any university in South Dakota, you would not have found an entrepreneurship program. Now, very few of the universities out there don't have an entrepreneurship program. And one of the reasons that exists, I believe, is because small business and entrepreneurship and innovation is very much the driver of our economy. Now, 30, 40 years ago, it wasn't uncommon for someone to go to work for a company and stay at that company their whole entire work lives. But anymore, it almost never happens. In fact, on average, you're going to likely change careers between 3 and 7 times in your life. And that doesn't necessarily mean jobs. So it's, again, very unlikely you're going to work for one company your entire life. I will say, and do want to note, though, that there are a lot of people that often give up on working for one company for rather poor reasons, especially if you're in a governmental situation or governmental job and you work for a state or federal governmental entity. You may or may not get paid more in the private sector, but often the one thing we fail to incorporate is the value of a pension plan, a traditional pension plan with governmental entities. Here recently, I was talking to a lady that was looking to go into the private sector and go work for a company, and she worked for SDSU, and she had failed to take into account how much her pension plan was worth if she were to leave the workforce, and she only had about 15 more years until she could have gotten full retirement benefits. Once she learned that the value of her pension plan by the time she retired was worth a couple $1 million, she definitely rethought about retiring and staying with her employer. So, but again, very unlikely you'll stay with the same company or work in the same job role your entire life. So knowing that, the best thing I can do to help teach is to talk about and to show you how to create options. And one of the sort of a hypothetical that we get into is we have to understand with small business how much business risk is involved with it. Very often people won't get into small business because they'll say, well, it's high risk. And to some level that can be true, but to some level that's not quite as accurate, and that can be illustrated with this hypothetical. It's all dependent on knowledge and where your source of knowledge is and your breadth of knowledge. So if you're the daughter of a successful farmer and you were active on the farm for the last 20 years, how much could that transfer over into owning a bicycle shop that sells bicycles? And how much risk would be associated with that? And the answer is, if you don't know much about bicycles, but you know a lot about farming, then getting into the bicycle business might not be the best option. And when you're looking at small business, you really want to ask yourself is what knowledge do you possess? And do you possess a lot of knowledge in that industry or within that business? Now, I probably should have prefaced this by saying that the daughter didn't know much more than to ride a bike in the bicycle business to complete that there, but didn't. So it's good to know that, again, how far away are you from your base knowledge set and your core knowledge set? And that gets into analyzing something called an Ansoff matrix. And this is something I taught in a finance course, USF's MBA program. And in Ansoff matrix, look at what a company currently does and operates and how they can expand and grow. And when you get into business, your goal is to always grow that business. I think it's Tony Robbins that says, if you're not growing, you're dying. And that very much is the case in business. So if we apply this to the young lady that is getting into the bicycle business, we'd look at, well, what does she currently know and understand? And that would be market penetration in the current environment. And she knows a lot about farming, grew up, raised, and helped her parents farm for 20 years. Maybe she's 30 years old. I don't know. So the least business risk would probably be continuing to farm and maybe buying some more land. Another way to grow and expand the operation would be on this Ansoff matrix would be product development. You might get into producing different commodities. Maybe you were doing wheat and you look at corn. Now, I apologize. I know absolutely nothing about farming, but just to illustrate the point, that's what we're going to talk about. Another way to expand would be to further do a market development, which would be sell the existing products, but maybe sell it in some different manner to different clientele. Maybe you try to go organic or something along those lines, and you're trying to sell to different people. Or in this case, you would sell to the same people or do the same thing, but do it to the same market, but do it with a different product. And then what usually holds the most business risk is when you're into both a product and market that you are completely unfamiliar with. So this would be the comparison of market penetration, or currently she knows a lot about farming, but she's trying to get into running a bicycle shop where she has no knowledge. And that same thinking is what we usually see is kind of a failure point when people buy existing businesses or start businesses, is they're totally outside their realm and understanding. Now that doesn't mean they have no chance of being successful. That's not necessarily the case, but it would have the highest business risk. So again, something to be aware of and to pay attention to. Now, a lot of times I will get asked, well, Bruce, if we put buying a small business into an asset allocation, how would you do that? And the answer is not very well. I think we're going to go onto a website called the Professionals Group in Sioux Falls. And on there, it's a business brokerage firm. And they have an average, I think I calculated their average list price for a small business was $524,000. And I did the math backwards to figure out that you would have to have probably more than $5 million to buy a business worth $524,000 if you wanted it to be in an optimal asset allocation. But that optimal asset allocation would also be applied to a situation where you're kind of in a diversified environment. Okay, most people that buy small businesses do get into business that's more around their core knowledge set. So with the daughter, it would be getting into farming. We'll get into earnings multiples and things like that. How we evaluate small businesses is very much similar to using the P/E ratio to evaluate stocks, which again is just the reciprocal of the earnings yield. And that converts into an average rate of return of small businesses after salaries of between 18 and 30% year after year, which is significantly higher than small cap stocks, which is 12.7%. So there's a lot of opportunity in small business to make quite a bit more. And actually, I think it's some 80% of millionaires are small business owners. So that gives you kind of an idea. Now, again, that $524,000 based on $5 million, or having $5 million in assets would equal about 10 to 12% of your money to buy that small business. So again, most people don't do that, but I always get a question from a student asking, well, how would that work in an asset allocation? So now you know. So the earnings multiple that most small businesses, if you ever watch Shark Tank, which I always have people say, oh, you must watch that all the time. And actually, I don't. It's a little like, I don't know. I told my wife, she's a microbiologist, and I said, would you want to come home and sit and watch a show about microbiology for another 2 hours or hour? And she said, well, no. And that's why I don't watch a lot of Shark Tank. But I have watched it, and a lot of students interested in it. And one of the things they talk about, if you want to go ahead and pause and watch a clip on YouTube, one of the things you'd hear them talk about is the multiple or earnings multiple or P&E, or just simply multiple. And oftentimes the people that are pitching their product and trying to pitch to these investors will try to oversell their multiple. Now, once the sharks or the investors know the multiple that they have in mind, they do the math backwards. They don't need to know a lot of information. They do the math backwards and sort of input numbers in their head, or sometimes you'll see them writing down. They'll be doing the math to figure out, well, how much is this really worth and how much is it worth today? So when we evaluate small businesses, we use just simply a multiple to plug in a little math. So I am going to go ahead and we'll go through a worksheet to find that. Now that data in these multiples, we always have to have a benchmark. I get these from a company called BV Market Data, and I have a subscription that I get for multiples for some, I think it's 1,000 different types of businesses with a standard industry code, and it tells me what the average earnings multiple or revenue multiple is of these businesses, and I'll actually go through and show you what that is. But BV Market Data is where I get that data from to run this. All right. Now, again, I said we don't always just look at earnings when we do evaluation of a small business. Oftentimes, what we'll do is look at a revenue multiple. So if you know how much a company brought in last year in revenue or gross revenue, we multiply that by a number, and then we can figure out how much that's worth. We add in all the other assets to it, and then we get what would be a average price range for business like that, and then we can determine whether or not the list price is too high and how much we want to talk and get that business price down to. And this is the formula of how we do this. We either multiply the earnings, cash flow, or revenue by the multiples, okay, that we get from this BV Market Data is where I get my data from. We multiply it by that, and then once we have that, and you get a range, you get a minimum and a maximum, one standard deviation range to get that, and then we add in the market value of all the assets, inventory, accounts receivable, etc. We add that, and what we get is a list price range of what it should be, or an intrinsic value of what it should be worth. From there, we can also better understand how to negotiate, and it can actually lead us to potential problems that exist within the business if it's not within these ranges. And again, we usually get a minimum and a maximum. So we're going to go ahead and we're going to do this exercise now. And I'm going to switch the camera over here. This is that worksheet. It's a little fuzzy, and I'm going to have to move this around just a little bit. Not real high speed here. Okay, again, small business valuation exercise. And the first business we're going to evaluate is a steakhouse. So the next thing I'm going to have open, I'm going to minimize this, and I'm going to go, you can just Google the Professionals Group in Sioux Falls, South Dakota. And once you get there, click on their businesses. And they'll have business listings, or scroll down, and you'll see there's a steakhouse listed, buy today for $1.25 million, $1,250,000. Again, for sale in southeastern South Dakota. We're going to click on View the Details. All right. So there it is. Don't worry about that section. So the next thing I'm going to look at, and I'm going to show you where I get this, is we have multiples that I've already put on the worksheet for a steakhouse. Okay, that's already been admitted, but we're going to pretend that we wouldn't know that. So I'm going to just scratch those off. But I need to find these multiples. Okay, we have gross revenue multiples and cash flow multiples that we need, and those are entered up here. So I'm going to go to my BV market data database, and I am going to look for, there it is, a restaurant. And again, this is just a database of all these different companies and the price ranges. This one would be closest to a restaurant. So I see over here, the multiples are, for my price to revenue multiples, are 0.30 and 0.45. Okay. And I'm going to re-enter those in. 0.30 to 0.45 are the multiples here. Then we have an earnings multiple. And if we look over here, we can see that the earnings multiple is 1.48 and 2.18. Again, these multiples come from BV market data. So the next piece of information I need to find is the gross revenue. Okay, and I'm going to enter that in, and the earnings. Now, this is one that is often called something else. We can call it cash flow. We can call it EBITDA. Trying to think what else. Earnings, free cash flow. On different websites, different business brokerageships, they call it different things. So for the steakhouse, though, you can see up here that the revenue, which would be gross revenue of the steakhouse, is $925,321 annually, or probably was last year. I'm going to go ahead and write down the 925,000 and some change. Okay. And I'm going to go ahead and enter the cash flow. Here on the Professionals Group, they call it cash flow. Okay, and that's essentially the earnings. That's the money the owners get to keep at the end of the year after paying salaries, paying for inventory, costs, etc. So 172 and 471. So the cash they get to keep is about $172,471. The next piece of information I need are the total assets. Okay. Now, if we look up here, we have assets, land and building. That'll be sometimes called F&E, fixture, furnishings, and equipment. PPE, property, plant, equipment. Land and building, and they may sneak in some other assets here or there. Now, I see right here that they have assets of $249,650. Plus, it comes with land and building that are estimated to be worth $610,000. So I'm going to add the assets down here plus the land and building. So I'll pull up a calculator, add $249,650 plus $610,000, and total assets I get $859,650. Now, under valuation prices, the next blank, don't worry about that. That will be entered in these blocks. All right, so I got some of the information down. I just need a little bit more. I'm going to go ahead and bring this up. It's going to be a little fuzzy, but I think you get the point of what I'm doing here. So the next thing I need to do is I'm going to multiply this gross revenue by these multiples, 0.30 and 0.45. Okay, that'll give me what my gross revenue is worth. So I'll pull out my calculator again, and 925,321. Again, this number right here, we're going to multiply that by 0.30. And we get 277,596. And you don't need to worry about the cents. Then I'm going to multiply the 925,321 by 0.45, and I'm going to enter that in right here. 925,321 times 0.45. I get 416,394. Okay. Now we're going to go over and we're going to do the earnings or cash flow multiples, okay, here. So I'm going to multiply 172,471 times 1.48. $172,471 times 1.48. Get 255,257. Now I'm going to multiply the 172,471 by 2.18. Get 375,000 986. And again, don't worry about the cents. Now, there's really, for this next numbers, I'm just going to draw a line straight through that with an arrow. Okay, so it would be $859,650 for the assets. Now I'm going to add this number, and we're going to put that down here. So I'm going to add 277,596 plus 859,650, and I get 1,137,246. Okay, I'm going to add again the total assets plus 416,394. And I get 1,276,044. Then we're going to go ahead and we're going to add this number plus this to get this. So 255, 257 plus 859, 650. We got 1,114,907. Okay, then we multiply or add 375,986. $859,650. Okay, so we're adding this to this. And we get 1,235,636. Okay. Zoom in on that just a little more. Okay. So this is really our valuation ranges. Okay. So better write down, go ahead and get rid of this. First, I'm going to write down the list price. And the list price on the Professionals Group website is $1,250,000. Okay, so this is what the seller's selling it for. These numbers up here are what we think it's worth, is somewhere in these ranges. Now, what I do, just to get a quick idea, is I circle the smallest one, put in minimum, and I circle the top one and put maximum. So no matter how anybody's sort of evaluating this, the business's price range should be somewhere between $1,114,907, and I should absolutely never pay more than $1.276 million for that. Now the price range is $1.25 million. Well, that is within those price ranges. So we kind of ask, is this appropriately valued? And the answer is yes, it is appropriately valued. I just circled that. Now, this also gets into when you negotiate a contract like this sets a couple things, which is called LAO and MPO. And LAOs are least acceptable outcome, and an MPO is most preferred outcome. So our preference in negotiating would be to get that price is close to $1,114,907. The least acceptable outcome is not going to be the maximum, because I'm not going to pay them more than what they're listing it for, would be $1.25 million. Okay. So I'd write down most preferred outcome, and this would be least acceptable outcome. And again, that helps me in the negotiation process. This would probably be my starting point, would be somewhere around there. It gets into the question of, well, wouldn't you want to try to get it even lower? You could, but the seller could also say they don't want to work with you. So if you lowball them too much, they can just say, look, don't waste our time. We'll find somebody else. So I would say that the list price is probably appropriately valued. But I noticed that it's at the upper end of the maximum. So if I were going in there, some of the things I would look at and be concerned about is, does the facility have relatively new equipment? What would be driving up this price to be at the higher end of my minimum and maximum? Why are they listing it at that? So it really helps, though, get you a base benchmark to figure out, is this the worthwhile price to pay for it? And it's a small business valuation. And I'm going to go ahead and do one more. The last part of the exercise, we'll get into a discussion post. And I'll have you evaluate your own business. You can look at a business anywhere in the country, and we'll have you do a valuation of that business that's being listed. And you'll have to post what business you're looking at, and I'll go ahead and send back the list of that market data or those multiples. Unfortunately, I can't send them out to you because it is proprietary information, and I have to pay a subscription to it. All right, so the next thing we're going to look at is a painting contractor business. And I'm going to minimize a couple screens here as we go through. All right. So on the professionals group in Sioux Falls, we have a professional painting and wood finishing business for sale. And the date is July 19th, 2016. And we see purchase price. You can buy it today for $975,000. But we got to figure out, is that price good? Would it be worthwhile to do that? Now I'm going to go ahead and jump around here, and I'm going to enter in the list price down here at $975,000. So if I were starting from scratch on this, the next piece of information I would want to find is from BV Market Data or any other consulting service or analytics service that offers these multiples, and I need to find out what they are. So I pulled up painting contractors on this PDF database and standard industry code of 1721, and I see a revenue multiple range of 0.31 and 0.42. Now I'll go ahead and write these down here again, even though I have them listed on the worksheet. And we have an earnings or cash flow multiple of 1.39 and a maximum of 1.87. So I'll go ahead and write those down there. All right. Next thing I need is the gross revenue. And revenue here for the business was $910,135. Okay, we found that under or next to revenue. Next piece of information we'll need is the cash flow earnings or earnings, which is 166,926. And the last piece of information I will need are the total assets. Now they have this time listed up here, and they have fixtures, furnishing, and equipment, that's what FFE is, of $211,491, and land and building where this stuff is located of $425,000. So I'm going to add this 211 and this 425 together to get my total assets. Pull up my calculator and go ahead and add them. All right, and I get total assets of $636,491. So the next thing I'm going to do, and I'll draw an arrow straight over knowing that I'm going to add all that in, going this direction. So the next thing I'm going to do is I'm going to multiply this gross revenue by my revenue multiple range of 0.31 and 0.42. So first one, 0.31 times 910,135. And I get $282,141. Then we'll multiply 910,135 times 0.42. Okay, that's right here. Multiply this by our gross revenue, and we get 382 256. Next, I'm going to multiply my earnings or my cash flow, 166,926 by 1.39 and 1.87. And I get, we'll enter it into these boxes, I get $232,027 and 1.87 times 166,926, and I get $312,151. Okay, now I got to start adding up these numbers. This total assets, 636,491, plus this number, then plus this. So when I take 636,491 plus right here 282,141, I get 918,632. When I add together our total assets plus our earnings multiple, we get 636,491 plus 382,256 we get 1,018,747. We'll add our total assets, 636,491 plus 232,27. I get 868,518 when I added this to my assets. And the last one, 312,151 plus 636,491. So 312,151 plus 636,491, and we get 948. I'm going to put a big mark there so you can separate them. 948 and 642. Okay, so the business listed by the seller at $975,000. But I think it's worth, if I circle the minimum or most preferred outcome is the lowest one of the three, or the four, excuse me, and I circle the highest one, which would be the least acceptable outcome, or the max, is $1,018,747. Is this business listed within that price range? The answer is yes. So I'd say it's appropriately valued. Now, it's not uncommon to find businesses that are listed above the valuation price range, just as it's common that some sellers of a house would list the house above a price point which their realtor recommends they sell it for. They're trying to get as much money as they can. So that's not uncommon. What's less common is to have a house listed or a business listed below the minimum valuation price. And to me, that would signal a bigger warning sign in the case of a small business purchase, because you'd ask yourself, why would any rational person sell the business for less than what most people think its value is? Maybe they were involved in a lawsuit. Maybe they had defective products. Maybe something else happened. In other words, that would be very questionable. Most business owners want to sell the business when these multiples are higher, or there's other purpose, other in-demand reasons to buy the business. So that's how you do it, and that's how you do a quick small business valuation to understand the process. Now, this actually can get much more detailed than this, and we can use a lot of other numbers to do that. But very much like the Shark Tank scenario, most business investors, business owners of non-publicly traded businesses are really just trying to get this information, because anything much more than this, and you're getting into sort of too fine a detail that may not be relevant, especially wouldn't be relevant in the purchase or investing into a small business. So the next part of this exercise, the last page of that, is I would like you, we'll add this topic in our discussion post, I want you to go out and look for a business you might be interested in that fits within your knowledge set. It can be anywhere on the internet. Look up businesses for sale, and that have, what you should see is something very similar to the professionals group, where you have a purchase price, you have the main assets, you have the revenue, and the cash flow. Now, from there, please email or please contact me on the discussion post and tell me what business that you're looking at, and then I will send back to you these revenue multiples and these earnings multiples or price multiples. Okay, so I'll send them to you, and it will start here. That'll be the first number I send you. That'll be the second number, third, and the fourth number. And you will enter those in here, and then you go through and do the same formula, add everything up, multiply everything by the multiples, and evaluate the business and see if it's listed at an appropriate price. Tell me if it's undervalued. Undervalued would be you can buy it for significantly less than the valuation price, or if it's overvalued, which would mean it's listed at a price point that's far above and away. Well, it's more than any of your calculated values here. Once you're done, you will turn this into your second project portfolio. You do not have to fill this out, or you don't have to fill this out online and open up the Word document and put the numbers in here. You can just take a picture or scan both documents, the first page and this second page. Go ahead and again picture or scan it to me and put it in the Dropbox. If you're interested in more about this, well, I encourage you to watch the television show Shark Tank and go out and find any other information on it. A couple other questions, or some other questions I get from students once they learn how to do this is, what increases the value or the multiple, that those multiples that are up here, what increases that relative to the business? And there's 6 or 7 things here that essentially drive those multiples to going up in an upward trajectory. In other words, people get more for their businesses compared to those multiples. And the first is that there's been indication in the business of revenue growth. That can also be called sales growth. In certain industries, selling in certain business environments, there might be just a ton of potential for sales growth for the products or services being sold in the business. Another would be earnings growth. The downside to earnings growth is usually earnings growth happens, which is you take gross revenue minus your expenses, and then you get earnings or net income that's left over. The earnings growth is often tied to revenue growth, but in more mature businesses, let's say like a fast food franchise, the earnings might be at a peak where there's not much left to figure out how to cut costs and do things like that. But earnings growth would mean that there's a lot of ways that costs can be cut, things can be made more efficient within that business. The opposite of that would be a turnkey business where there's little to no fine-tuning needed, and it's about as efficient and effective as could be. Another thing that could cause the multiple to increase would be financial risk decreasing, which would be the standard deviation or variance in earnings. Higher risk expands the range of the. So again, if you decrease the standard deviation or the fluctuation of earnings, in other words, how the earnings go up and down, if you can shrink that as much as possible so there's not a lot of deviation in your year-over-year earnings, when you shrink that level that it fluctuates, you're decreasing financial risk. When you do that, those multiples have a tendency to go up to higher levels, and they shrink between the highs and the lows. The other way to increase the value of a business would be to have a competitive advantage. Anytime you can increase a competitive advantage in that business, you could probably sell it for more. Lastly, would to make sure the business is totally strategically aligned within the competitive industry that it operates in. And if you want to learn any more about this stuff, that's great. Go ahead and do your own homework, search online, or go get an MBA. I believe that should do it, and we'll look forward to seeing you in the next video.